Hello, everyone. Welcome back to the Weekend Charts. I'm your host, Charlie Bilello, bringing you once again the most important charts and themes I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment and hit that subscribe button for all the latest content from us. So much to talk about today, a lot on the docket. We're going to talk about the latest payroll data. I'm calling it a confusing labor market. We'll run through that. Distorted inflation data, a lot of problems with the latest CPI report. We'll talk about that. And unnecessary and unwarranted easing. That's what I'm calling the latest rate cut action by the Federal Reserve. I'll talk you through why I think that's the case. The return of QE. Federal Reserve was not content with simply stabilizing their balance sheet after the end of QT. They are starting QE once again here earlier than expected. The lower rates litmus test, I'll discuss what that means. The year of the comeback in the equities market, in the economy, and we'll end, as we always do, with something positive. That will be lower gas prices at the pump and rising real wages. Here we go, a confusing labor market. Everybody talking about the latest jobs report, a lot in there, a lot of conflicting signals going on in the labor market. Let's first talk about non-farm payrolls here, and really you have to look at a trend when it comes to non-farm payrolls. You can't look at any particular month. There's so much noise in there. So what I'm showing you here is a rolling 4-month average in terms of payrolls in the United States. And what we've seen in the most recent reading here, 10,000 jobs were added over the last 4 months on average. That's down from over 200,000 a year ago. So clearly labor market is slowing. The question is, why? What's going on here? Digging through the numbers, what's the explanation for this big reduction in terms of the number of jobs that were being created in the U.S.? And is this an indication of a recession? Because as we've talked about in the past few payroll reports, what we're seeing is a significant slowdown in overall hiring in the U.S. We're now seeing a 0.6% increase over the past year. And anytime we've seen this type of slow payroll growth in the last 50 years, it's preceded a recession in the U.S. So really the question has to be, is this time different than the last 50 years? And some are arguing, yes, it's definitely different, and they're arguing different reasons for that. And before we talk about that, this real latest payroll data that we got here for the month of November was confirming the other data that we got during the shutdown, namely the ADP report here, which showed a similar slowdown. I'm showing you here a 3-month average of ADP data, which showed in its November reading a decline of 4,000 private payroll sector payrolls per month. So both of these reports showing a slowdown, and really the question is why. And a lot of people are talking about changes in levels of immigration being a big reason why we're seeing this slowdown. And the question is, how much is attributed to that? And the Minneapolis Fed did a study recently where they're saying about half is going to be attributed to that. They're taking a guess here. They said it's a pretty big range. Some people argue it's more. Some people argue it's less. But you can see here they're breaking down immigrant-heavy sectors versus non-immigrant sectors. And while both are trending down, you could see clearly the immigrant-heavy sectors seeing a decline in payroll growth over the past few months, much sharper than these non-immigrant sectors. So clearly that's part of the reason. And what's interesting is that Jerome Powell recently in one of his press conferences was talking about the fact that we tend to see an overstatement of jobs overall. And we've seen that in these huge annual revisions that we've gotten the past few years. 900,000 to the downside was the most recent one that we got. And what he said is that the model that the BLS uses, which is this birth-death model, it really is overstating the number of businesses that exist in the U.S., and therefore he's saying that it's overstating jobs by about 60,000 per month since April. And so if he's saying if job growth is averaging 40,000 in that period, if it's an overstatement of 60,000, we're actually seeing a loss of 20,000 per month. Now, this was before the latest payroll data, so maybe he would have different comments today. But it's clear, any way you look at it, that the numbers seem to be lower than what they appear, and we see that time and again with these downward revisions. Now, if we take away the immigration factor, we take away this birth death model and that it's overstating the number of jobs, other factors going on here. Are we seeing a cooling of the labor market outside of those factors? I think it would be hard to argue that we aren't. And here's a number of things that I am looking at to really confirm that. Number one would be the unemployment rate. So people that are out of work and that are actively looking for a job, well, that moved up to 4.6% in the month of November. That's the highest we've seen since September 2021. Still well below the historical average, which is 5.7%. But if you look at this chart here, again, one of these examples last 50 years and even further back, every time it's moved up this amount off of a low, we've seen it continue to move up. We've seen a U.S. recession. So once again, you have to ask that question. Is this time different this time around? It's already different, I would say, because in the past, when we've seen an over 1% increase in the unemployment rate off of a cycle low, which we've already seen now, well, you've already been in a recession every single time. So we're already different in that the U.S. economy here and now, it would be hard to argue that we're in a recession with GDP growth still being positive, still seeing an economic expansion. So it's already different. But the question is, will it continue to be different if we see this unemployment rate continue to rise? Other factors pointing to a cooler labor market, just looking at the relationship between unemployed people in the United States and the number of job openings. And for a while, we had really the tightest labor market that we've seen in history. So many job openings in the U.S., over 12 million. Post-COVID, that was way higher than the number of unemployed people in the U.S., a record spread. And now we've seen the two cross over. So now there's more unemployed people in the U.S. than the number of job openings, which has been trending down. So you could see the two numbers crossing over. That doesn't mean we're in a recession here. You can see it's kind of more normal looking historically pre-COVID to see the number of job openings be below the number of unemployed people. You could see the huge gap we had, of course, after the global financial crisis, and that was the worst recession we've seen since the Great Depression. But even before that, you saw this situation where unemployed people outnumbered the number of job openings in the U.S. So we were in this brief period here since 2021, really, where it was an abnormal relationship, super, super tight labor market. And now with this gradual loosening over the past 4 years, now we're back to a more normal state, I would say. But watching these two closely to see if this relationship continues with more unemployed people, so seeing that number rise and fewer job openings. And if we're talking about the number of people quitting their jobs, this is something to look at in terms of how much are workers thinking that they might lose their job. So if you're thinking you might lose your current job, you're going to be less likely to quit your job, and vice versa. So if you think that there's a lot of job openings out there, as we saw a few years ago, you're more likely to quit your job. That's a tighter labor market, a stronger labor market. This hit a record high of 3% a few years ago, and now we're down to 1.8%, which is the lowest since May 2020. So workers fearing more today, quitting their jobs, not yet at the levels we saw during the recession in the global financial crisis, but starting to get to levels that you tend to see during labor market weakness. And lastly, I would talk about just average hourly earnings here, indicating the labor market is cooling here. Employers don't have to increase wages as much when you have a looser labor market. Still seeing pretty strong growth here, 3.5% over the last year, still above the average here historically, but it's the smallest increase we've seen since May 2021. So all of these factors, I would say, are pointing to a slowdown in the labor market, but because of that big immigration factor, because of what Powell's talking about, perhaps overstating jobs previously, well, perhaps the slowdown isn't as big as people are assuming here if you're just comparing it to prior cycles, because there's a lot of differences today. And the best way to look at that, the best, I think, counter argument to say the labor market really isn't that weak just yet, is to simply look at the number of people that are filing for unemployment claims. So jobless claims, the best real-time look at the labor market here. And if we look at 4-week moving average here, you can see we're near the lows of the year. So after that spike in the first half of the year, this has come down, and it's really at levels not consistent with recessionary readings. So if we were in a recession or entering a recession, you would see it really an unrelenting rise in the jobless claims number. That's what we've seen every time in the past. So what we're seeing today is a hiring slowdown. So companies are not hiring workers at the same pace that they were a year ago or 2 years ago, but they're not yet laying off current workers. And so when that relationship changes, the first place we'll see it is in this initial jobless claims number. So we'll be watching this closely heading into 2026. Now let's talk about the inflation report that we got. So because of the government shutdown, a lot of distortions in this latest CPI report, and that's what everyone was talking about this week. How much can you trust the move down in the inflation rate? So what we saw was the overall CPI in the US moved down to 2.7% from 3% previously. This is for the month of November. And the core rate of inflation, which excludes food and energy, that moved down to 2.6%, which was the lowest we've seen since 2021. So here's the question. Are these numbers to be trusted? Because there was such a huge beat versus expectations. You're talking about people are expecting about 3% for both of these numbers and a big spread there. And the question really comes down to what is going on in terms of the methodology, in terms of especially how did they calculate shelter inflation. So in terms of the weightings in the CPI report, shelter is far and away the biggest component of CPI. It's over a third of the index. So shelter came in at 3% for the month of November. That's a year over year reading. That was down from 3.6% in the month of September. So very rapid decline in shelter CPI, and that was responsible for most of this beat in terms of CPI, most of the decline down to 2.7%. And you could see here, some of this was to be expected. We've been talking for a long time about the disconnect between real-time U.S. rental prices in the U.S. and shelter CPI, the huge lag between the two factors, and U.S. rents have been down on a year-over-year basis for a few years now, and you see the slow trend lower in shelter CPI. But really the question is, why such a big jump over the last 2 months in terms of that shelter CPI number? So a number of people are pointing to inconsistencies in terms of this latest inflation report. There are gaps in the data, so a lot of the categories didn't have numbers for October, for November, and it seems like the October data that was missing made the November housing cost numbers look smaller. So this factor that they call owner's equivalent rent, where they're trying to assess what you would rent your house out for and use that as a cost in terms of shelter. Well, they're saying here that that missing data for the month of October was essentially used to put zero for a lot of what they were doing, estimating for rent levels in October and November. And of course, that's going to push down the shelter CPI numbers. So a very confusing data point. The BLS, unfortunately, hasn't really cleared this up yet, explaining how they arrived on that shelter number and other numbers when they had this missing data across the board for these 2 months. So really, it's a question of, are we going to see a move back higher for the month of December? When we get that report in January, we're going to see a reversion back to a normal number. Will we fill in these gaps that we saw during this inflation report? And that comes down to whether you believe that decline in shelter was warranted or you don't. And so clearly, if they were just putting in zeros because they didn't have the data, that's a downward bias that shouldn't be there. But we really have to wait till we have an explanation for them. But I would say don't rely very much on this one inflation report. There seems to be too many conflicting data points in here that don't seem to line up with prior reports. So if we're talking about the overall inflation picture in the U.S., the big question, of course, still is what is going to be the ramifications, the impact from the tariffs. And so a lot of people are saying, Well, it's been great this year. We haven't seen a huge move up in terms of inflation from the tariffs. And I would say hold off on declaring victory just yet because we don't know the true picture because of that front running of the tariffs that occurred in the first quarter of this year. So, incredibly, we only have data through 9 months, but we've actually seen the trade deficit widen through the first 9 months of this year, 17% increase from the prior year. And the reason for that is the massive front running of tariffs that occurred in the first quarter of 2025. Why did companies increase their imports by a huge amount during the first quarter? Well, simply they knew that they were going to have to pay a higher price going forward. They didn't know exactly what it was going to be. We still don't know where the tariff rates are actually going to shake out, but they bought months and months and months worth of inventory in that first quarter. And now we're starting to see this ratio normalize here in terms of the trade deficit is actually moving lower. So that means in the fourth quarter, once we start getting the data, it's likely that companies will have to now go out and replenish the inventory that they've been working off. And only then will they start thinking about how do I pass these costs on to customers? So very likely we won't see the true impact from the tariffs in terms of inflation until 2026. Probably maybe in the first half we'll start to get a better reading on how much is the increase in terms of prices going to be from the tariff impact. But until then, the jury's still out. There's still people arguing both sides saying we won't see a big impact, we will see. But I think it's clear we don't yet know what the impact's going to be until these companies have to go out and buy these goods again at these higher prices because they've been delaying, as a company would do, as long as possible, trying to push these price increases onto the end consumer. So I think it's likely we're going to see an impact. How big is it going to be? Well, there's too many moving parts to predict that. But I think we'll get a better read on that in the first half of 2026. So in terms of the Federal Reserve, they cut interest rates as expected once again in the month of December here, and I'm calling it an unnecessary, unwarranted easing. I'm saying unnecessary because you had the stock market at all-time highs. Once again, for the third time this year, they cut each time the market was essentially at all-time highs heading into the rate cut, and they still cut interest rates. You still have elevated home prices, gold prices hitting all-time highs, the money supply increasing once again, hitting all-time highs, national debt every single day hitting new highs. And here's the key thing, the Fed's inflation target of 2%, well, we've doubled that over the past 6 years now. So that's a long period of time of above average inflation. And the Fed is really ignoring that part of their mandate by continuing to cut interest rates, even though inflation levels are so elevated. So regardless, the Fed chose to cut interest rates, unnecessary in my view, and unwarranted because of this inflation picture. So they cut interest rates and they also announced quantitative easing, as I'll talk about in a little bit here. Fed funds rate versus CPI. This is simply what the Fed is looking at. So if you listen to the Fed, you listen to Jerome Powell, none of the prior inflation that we saw, so this big spike in terms of 9%, the cumulative inflation doesn't seem to matter to the Fed whatsoever. It's simply they forget about it. They want you to forget about it. All they want you to look at in terms of the Fed is what is the inflation rate over the past year and how does that compare to the Fed funds rate? And their argument is if the Fed funds rate is higher than that inflation rate, well, then monetary policy is restrictive and they have room to cut interest rates. And so that will be their argument why they continue to cut interest rates here, simply because the inflation rate over the past year, they didn't have this number yet, but it was 3%. And so they had room to cut it once more. And they've cut now 175 basis points since September 2024. And again, they really want you to ignore the price increases that we've seen over the last 5 years and just look at the last year. And to them, 2 to 3% inflation over the last year is palatable enough where they can cut interest rates. But just looking at some of these increases over the last 5 years, you can see this is why people are talking about an unaffordability crisis in the U.S., where many of these things have become out of reach for people because their wages haven't kept pace with the increases in prices. We're looking at transportation increasing 42% over the past 5 years, coffee prices 44%, home prices 45%. We're talking about ground beef 62%, auto insurance we've talked about a lot 65%. So many of these increases is why the U.S. consumer is so grumpy when we're talking about the different consumer sentiment polls. And this is the cumulative factor. This is the main factor that the Fed should be looking at. What has the inflation rate been relative to their 2% target over the past 6 years? And if you look at this number, really there's no justification, in my view, to cut interest rates unless you're simply saying forget that 2% target, because we've essentially doubled the Fed's inflation target over the last 6 years. We're about 12% above the 2% inflation trend line. So how in the world could you justify lowering interest rates when you have this picture? And the counter to this would be people saying that the Fed is looking at the labor market weakness and that warrants cutting interest rates. And my response to that would be there's no evidence that cutting interest rates is going to create jobs. In fact, the Fed has cut 175 basis points now since September 2024. And look what has happened to the labor market. It's continued to weaken month after month. So if cutting interest rates created jobs, we would have started to see that. It doesn't create jobs. Companies don't talk about hiring workers because interest rates have come down 1%. They're going to pocket that money to hire workers when they need to hire workers in terms of they have more demand. So if we're talking about inflation, we're talking about the economy here. The Fed cutting interest rates, all else equal, will lead to higher inflation in the long run. I don't think that's a good thing, and I don't think the Fed abandoning their 2% target is going to be a good thing in the long run. But in the short run, the markets seem to be very happy about the Fed continued easing. We'll talk about that in the equity market section. First here, we got to talk about the return of QE. A little bit of a surprise here in terms of this announcement. They just ended quantitative tightening, the Fed, at the end of November. And immediately here, they're going back to quantitative easing. They don't want to call it quantitative easing. Look at the headline here. The Fed is buying billions in treasury bills. Just don't call it QE, but it is in fact QE. They are creating money out of thin air to add to their balance sheet. They said they're going to buy around $40 billion in treasury bills per month. So this will reverse what we've been seeing over the past few years in terms of the Fed trying to normalize their balance sheet. They decreased their balance sheet by $2.4 trillion from April 2022 to November 2025. I didn't see any reason why they should have stopped this. We weren't even back to pre-COVID crisis levels. I thought they should have continued to unwind the balance sheet, but they decided to end that. And not only did they decide to end it, they decide now to do this new buying program, starting with treasury bills. And so they're not calling it QE because they're not targeting longer duration assets, but I think it's only a matter of time before they're going to announce that. I think at some point in 2026, we're going to be talking about the Fed instituting a bond buying program in terms of the long end of the curve. Why do I say that? Because the long end is not responding to the Fed's interest rate cuts. The Fed has now cut 175 basis points on the short end, so reduced short-term interest rates by 1.75% since September 2024. And back then, the 30-year yield was below 4%, and today it's above 4.8%. So long-term bonds not responding, long-term bond yields going higher. Why are they going higher? Because we're still increasing the debt. We're still running a big deficit, and the market is pricing in still elevated inflation rates. So as I've said a few times, the Fed might be done with inflation. They don't want to talk about inflation anymore, but the market's inflation is not done with the Fed. So this is going to be a factor until the Fed decides we've had enough. And probably if this rises above 5%, it's going to start here strong calls for the Fed to do something about this and start buying long-term treasury bonds once again to drive it lower. So really what the Fed is going to follow if it pursues that path is what the Bank of Japan followed for a long time, essentially with the Federal Reserve taking control over the entire bond market because they want interest rates to be lower and they don't care about the inflation rate. So really what's interesting is that the Bank of Japan now is starting to reverse those policies, and the US is really just getting started once again pursuing this path because they don't want to have discipline in terms of the federal government balancing the budget, reducing the national deficit levels. They don't want to pursue that path. So if you don't pursue that path and you're pursuing higher rates of inflation, well, in order to keep the government interest rates down, you're going to have the Federal Reserve help you out and go out and buy these longer term securities. So it'll be interesting to see the direction of the 30-year in anticipation of the QE. Of course, when it's announced, you're going to see a massive rush to front run the Fed to buy these securities before these interest rates go down. Needless to say, I don't think this is a good path to follow. I don't think in the long run you want the Federal Reserve taking more control over the bond market. In fact, I don't think the Federal Reserve should be allowed to do the quantitative easing in the first place, but simply no one out there in Congress talking about taking away the power of the Federal Reserve in terms of doing this bond buying program. They seem to be very happy with the Federal Reserve distorting the economy, and that's exactly what it is. They don't want to let the natural rate of interest exist, so they're going out and distorting it by printing money essentially and buying these securities. So in terms of the Federal Reserve, we're going to have a new chairman next year, and this is the litmus test. There's really one question when it comes to interviewing new candidates for this role, and that's, are you going to lower interest rates? And President Trump made it clear once again that is the main question. He says the next Fed chair will believe in lower interest rates by a lot. So not just they're going to cut once or twice in 2026. I think he wants them to cut aggressively. He's talked about cutting down to 1%. He's also said that he thinks the U.S. should have the lowest interest rates in the world, which would imply 0%. And here is what the betting markets are saying in terms of the candidates here. Kevin Hassett is first here, 55% probability at Polymarket. Kevin Warsh, 20%, and Christopher Waller, 12% in terms of the probabilities. Obviously, this can jump around a lot, but in terms of the selection process, that's going to be the number one question. And I was watching this interview this week with Kevin Hassett, the leading candidate here in terms of what the betting market's expecting. And he was all about lower interest rates. He said that President Trump is right. There's lots of room for lower rates. So not focusing on any of the inflation stuff that I talked about in terms of the inflation rate being double the Fed's target over the past 6 years, just purely focused on lowering interest rates. And he's talked about it, and President Trump's openly talked about it. They want to lower interest rates in part because of the huge national debt and the huge amount of interest expense that's going to that national debt. And if we have all of these short-term treasury bills and the Fed can cut interest rates down to 1% or 0%, well, that lowers the interest that we're paying in terms of that national debt, which would be a huge benefit that the government doesn't have to pay that. They could do other things with that money. Of course, in the long run, the problem with that is it's going to create more inflation. But in the short run, I could see the appeal to that. And here's that quote from President Trump: "We should have the lowest interest rates of any country, and we don't, and we should." And so looking where the Fed funds rate is here, 3.63%, so between 350 and 375. Switzerland is at 0. So what he seems to believe is we should be at 0 again. We tried that for 7 years. Maybe there's going to be a push to go back down there again. The problem is going to be that even if he appoints Hassett or Warsh and they promise to lower interest rates, they don't have control by themselves. So there's voting members on the Fed, And just because you appoint a chairman who believes in much lower interest rates, well, he has to then convince the rest of the members of the voting members to lower interest rates as well. I think that's going to be a tougher task. So they can't simply replace those other voting members. They have long terms, and not all of them are appointed by the president. So really, it's up to that new chairman to convince them that there's a strong need to lower interest rates. If we look at the dot plot projections that were updated in December, it seems like that there's not a broad consensus for extremely lower interest rates in terms of the current members who gave these projections. What they're saying essentially is this is a median forecast, only one rate cut in all of 2026 and only one in all of 2027. So that would be a very gradual easing process, certainly not getting down to 1% or the lowest interest rates in the world. Very gradual in terms of what the members are projecting here. And what's interesting is their inflation projections are not even getting to that 2% target until 2028. So they're saying they're going to do additional easing, but still not going to be at the 2% target on a year-over-year basis for another few years, which is interesting to see. So if this happens and we don't have a rapid move lower in inflation, I think it's going to be a fight within the Federal Reserve, with many of them saying, really, there's no justification to cut interest rates here anymore. And then you're going to have the other side, likely the President Trump appointee and other people affiliated with that camp, saying we need to aggressively lower. So I think for the first time in a long time, you're going to see a wide dissent within the Federal Reserve. My view in terms of appointing someone, of course, you want the Federal Reserve to be independent. I don't think the Federal Reserve should be setting interest rates, but the only thing worse, in my view, than the Federal Reserve setting interest rates is a president or Congress influencing the direction of interest rates, because of course they're going to be looking at what is good in the short term so that their popularity increases, or they'll get reelected or their party reelected, and there won't be likely thinking about what's the long-term benefit for the American people. So as I've said many times, I don't think the Fed should be setting interest rates. The free market should be setting interest rates. But if you're going to have a Federal Reserve set interest rates, it certainly shouldn't be influenced by a political party or a political appointee, because you're going to have this situation where they're trying to do something that's good in the short run, perhaps stimulative in the short run, but not good for the long run. So what we're looking at here is the market's expectations for the Fed funds rate looking out in the next year. So the market is betting on 2 rate cuts in 2026. So even though the Fed is projecting just one, the market's saying no, there's going to be additional easing. But if they really believe that the new Fed chairman is going to get rates down to 1%, I think this would look a lot different. So really the market, I think, is betting that's going to be much more difficult than perhaps what President Trump is thinking in terms of getting that consensus to push rates down meaningfully lower. And in terms of the betting on the Fed funds rate, where it's going to be, we know these projections are often wildly wrong. The best you can do really is look at the next meeting, and as it gets closer, it gets very, very accurate. So we're still a ways away from the January 28th meeting in 2026, which would be the first meeting of the year. But as of now, the market's betting that the Fed does nothing. So 78% probability the Fed holds the line after cutting rates the last few meetings, which of course is going to provoke a negative reaction from the camp that's saying that rates should be aggressively lower. So as of now, markets betting that the Fed will pause in January. Some are saying that Powell does not want to go out with any more rate cuts, because just in case inflation spikes up again, he doesn't want to have that on his record that he was aggressively cutting. So perhaps he's going to push for the Fed to pause here until there's a change in leadership at the Fed. And looking at longer term here, looking at 2026 year end, the market's betting 3 to 3.25%. So not significantly lower, just 2 rate cuts throughout all of 2026. And I can almost guarantee you picture is going to be different in terms of what actually happens. It's going to vary wildly throughout the year as we get new data in terms of inflation, employment. If the inflation picture that we just talked about in terms of CPI, is it really 2.7%? Or is it really higher than that? If the next report shows that it's actually higher, then you're going to see these odds change, I think, for sure. And in terms of the Fed being pushed to ease unnecessarily, and I think that's what they've done this year, and really the push is for them to do more of that and really ignore inflation. I think that would be the primary reason you could point to for why gold is having such a strong year, up 65% now on the year, best year since 1979. So gold really thrives on monetary debasement, not sound money, and this is not sound money policy if you're doing unnecessary rate cuts and really ignoring the inflation side of the mandate here. So I think this is the strongest argument that people are talking about for this year for gold. Now, of course, next year, if things change, we don't pursue these bad policies, of course, that story will change. But I think the best explanation, if people ask, why is gold doing so well so far this year, I think you would have to point to the unnecessary easing from the Federal Reserve. Let's talk about the equity markets, the year of the comeback here. I say that because back in April of this year, it seems like a long time ago, a lifetime ago, but if we're looking at 66 trading days into the year, back on April 8th, it was the worst start to a year, fourth worst start to a year in history, worst start since 2020. And before that, you had to go back to the 1930s. So very bad start for the S&P 500, but we saw one of the biggest comebacks in history here. Year of comebacks, really, in terms of the stock market and the economy, because expectations were just so low in early April. Here we had that bear market, 21% decline, but a 43% advance from there, with the market hitting many more all-time highs along the way. And if we look at the recession odds here, just an incredible chart. About 2/3 of people, when I put out a poll in early April on X, thought that we were going to a recession this year. The betting market was about the same in early April, about 67% chance of the U.S. entering recession. And today it's essentially zero. So just an incredible comeback in terms of the market and what people are expecting for the economy. And in terms of the S&P 500 corrections, every year we're going to see this. We're going to add to this list in 2026 for sure. The reasons will be different, but the story is the same. You're going to have declines, and you're not going to know when you're in the midst of it how big the declines are going to be. So this year we had two corrections. One was a bear market, 21% from February to April, and the other October to November, pretty mild pullback on AI bubble fears, 5.8% decline. Expect many more of these in 2026, again, likely to be a different reason. And if we're looking at the number of big down days for the S&P 500, remarkable, we're right at the historical average. So if it felt like a very volatile year, it really wasn't. 29 big down days, so 29 days with a 1% or more decline for the S&P 500. That's exactly the average since 1928. On average, you see 29 of these. Of course, more volatile than 2024. We only had 19 of these, but 29, not very big at all. And if we look at the VIX here, I just calculated this today. What has been the average VIX level so far this year? 19.1, which is right around the historical average for the VIX, which is 19.5. So in terms of volatility, very normal, very typical year for the stock market. And of course, if we didn't have these big down days, we didn't have the corrections and bear markets, you wouldn't have the upside. So I always say be thankful that this risk exists, or you wouldn't have the reward, and the long-term reward for the U.S. equity market has been tremendous. Of course, 10% per year on average over the last 100 years. Let's end with something positive. As we always do, that would be lower gas prices and rising real wages. AAA calculates this every week. National average gas price in the U.S. is now down to $2.89. That's the lowest in over 4 years. So great to see gas prices below $3 a gallon. Of course, it's a big expense for anybody that drives. It's obviously the inputs in terms of crude oil and gasoline into other areas of the economy as well. So great to see this moving lower. And I'll end with the most important chart for an economy. And of course, that would be wages versus inflation. And for a long time, over 2 years, we saw this moving in the wrong direction. We saw inflation much higher than people's wage growth. Not a good situation. But for the last 31 months now, we've seen a good situation where average hourly earnings, so people's wages are going up more than reported CPI inflation. That's a great thing to see. We want to see this continue going forward. So hopefully in 2026, we'll see this trend continue. And with that, we'll end it there. Last week in charts of the year. Thank you so much for joining me this year. Have a Merry Christmas, Happy Hanukkah, Happy Holidays, everyone. If you're watching this on YouTube, hit that subscribe button, and I'll see you next year on the Week in Charts.